ultimately, when this bubbles up, if Melvin does get margin called, it could have pushed the price of GME so much so that it actually ends up margin calling Citadel. Ooh. Oh, excuse me. Just put that back because we have a question to answer before we can celebrate. But make sure to watch until the end of the video to see what we do with this. Our question today comes from Ivan. Ivan is asking, someone in the chat is asking what a margin call is. What chat are we talking about? We're talking about the daily Market Watch live stream that we have every single day. Come on and chill with us. We go bell to bell starting at 6-ish a.m. Pacific time. All right, a margin call. Let's think about that as a Mr. person that loaned you either money or shares wants you to pay him back. And pay him back before when? Well, usually when you have a when you go out and borrow either money or shares, you have no deadline. You just have interest that you have to pay. For example, if I want to borrow one GME share, sure, I would have to pay interest on that every day. And we know that the hedge funds are hurting millions of dollars of interest a day. But on a normal basis, this kind of borrowing doesn't require me to give it back anytime. It makes sense as long as I have enough money for interest. However, as GME's price increases, right, I might not have enough money. And I'll symbolize this with a little thermometer here. So I have this thermometer going up that has on a dual axis here how much money I have and how much money a GME share costs, right? So this is the price of GME on the left side and the amount of money that I have on the right side. As that bubbles up, I am going to, since I borrowed this share, start running out of total amount of money. And this is all money I have in all assets, right? It could be shares, bonds, right? Real estate. But really, all that really matters is that I have a certain amount of money that I keep on my books. And ultimately, if GME rises to an extent that I can't cover the amount of shares, for example, right now I only have one share. But what if I had 1 million GME shares? And I needed, and I borrowed this amount, and GME's price continues rising, I'm ultimately going to not have enough money to be able to match the sheer amount of shares that I owe. What to do in that situation? Well, I'm going to have to liquidate everything, sell everything to make room for the GME that I have to now purchase and give back to the people that I borrowed it from. We can see the same thing happen to you. That's right, you can also be margin called. Let's say that you wanted to buy GME. You wanted to buy, since GME is around 180 bucks right now, you wanted to buy 100 shares. That would cost 180 plus 2 more zeros. That 100 shares would run you 18,000. But you don't have that money, so you borrow it on margin, right? You buy these stocks on margin, and now you have to pay interest on a daily basis. Oh, sorry, you have to pay interest on whatever arrangement you make with your broker that you borrowed it from in exchange for 100 GME shares, right? This 100 shares is ultimately going to bite you in the butt if it turns out that all of the money that you have on, because you don't just have 18,000, let's say that you actually have 30. These are some arbitrary numbers here. But you have 30,000 total amount of money, and the GME shares, as you continue dwindling down lower and lower, ends up decreasing the total amount of your money below the total amount of money that you owe. You owe $18,000. You have a total of 30,000, right? So there's 12,000 in here that isn't money that you owe. If at one point you end up seeing GME's price plummet, right? So 100 shares of GME is always going to be 100 shares of GME, but 100 shares of GME right now is worth 18,000. If it's ever worth less than the amount of money that you actually have in the bank, then we know that you can't afford to have the GME continue to plummet. So in that sense, you are going to be margin called as a long participant in the market. So in that sense, there are multiple ways to get margin called. Individuals can get margin called. Entire hedge funds, like billion-dollar hedge funds can get margin called. The reason why this is an important mechanic to understand is because of the mix squeeze, the margin call squeeze. Go ahead and just Google Andrew Mo margin call squeeze for an entire 6-minute video about exactly how this works. But in essence, we have multiple, let's draw the thermometer one more time. I am not good at drawing thermometers. You draw that thermometer one more time, but on this side is amount of money that individual hedge funds have up the thermometer. So Melvin is a relatively smaller hedge fund, right? And Citadel is a relatively larger hedge fund. When the price of GME, so GME price is still on this side, increases, you're going to start bubbling up towards the amount of money that Melvin has. This is what happened back in January. Melvin started running out of money. Citadel came and actually took Melvin's position here and bailed them out to get a little bit more. Now Melvin's up here because Citadel was helping them out. So this is a theoretical thermometer in the sense that you can still end up getting more money in order to move your position upward. But ultimately, when this bubbles up, if Melvin does get margin called, it could have pushed the price of GME so much so that it actually ends up margin calling Citadel. That's why Citadel wants to support the lower short whales, because those are the ones that are currently acting as buffers, acting as, middling countries in an all-out war against the most wealthy members of the short whales. However, as DTC regulations continue to start cracking down on the amount of money, amount of liquidity that you need, which lowers this bar here, since some of your money needs to be given to the DTC in order to cover for risky uncles. We've talked about NSCC 005, which came out and started gathering a bit of speed and a bit of renown earlier this week. We are likely going to see more regulations that either move the thermometer on this right side of the axis up or downward. And then independent of how the price action of GME works, we might see that margin calls, like the one that happened in Archegos, is going to just be a foreshadow for the oncoming economic disaster. Finally, the most important piece about the mixed squeeze is that when these hedge funds get margin called, they're going to have to get that money somewhere. And that money is in retirement funds like yours, 401ks, and the stocks that you care about, right? So tech stocks and the SPY. We've seen too many DDs that have talked about inverse relationships between GME increasing and all of these other market components decreasing. That's because normally, in order to cover for the shorts that currently exist, even if you're not getting margin called, you're going to have to take out your position from these different investments that are non-GME and AMC related. Hopefully that answered your question, Ivan, and whoever it is that Ivan's speaking on behalf of. If you guys want to hear more technical analysis and visually explained technical concepts, well, all you need to do is help us click that subscribe button. And the people that have went above and beyond and clicked that join button too, or gone down to Patreon and supported me there, are now showing up over here on the Moon Platoon, over here at the Space Legend and the Gorillionaire tier, that coveted tier where they can see my 6-figure investment portfolio. They get to have monthly private live streams with me, answering any kind of questions that they have, and just hang out with me on the regular. Hey, thank you guys for being you. Thank you guys for supporting the show, and we'll see you in the money.